Hi folk, Michael here. In my previous video, I gave a brief overview of fundamental versus technical analysis. So where should you start? In this video, I'm going to share my personal experience and opinion as both an academic professor and a retail trader. AI such as ChatGPT combined with Python lowers the barriers to entry. Look, it's never been easier. So there are many helpful online Udemy courses, for instance, on ChatGPT for Python, data science and machine learning, or algorithmic trading with Python. Why do I keep saying Python? I just think it's a great language for finance and coding. It's also never been a better time with freely available open source data from sites such as Yahoo Finance, as well as affordable subscriptions for fundamental data from places like EOD, like end of day historical data, or EOD HD. Now, some personal experience and opinion, ChatGPT 4.0 can be a bit slower, I have found, than some other versions, but in my opinion, the extra capabilities and intelligence are worth it, the creativity. And the paid plan is great for those who are serious about using AI like myself. I just can't recommend it highly enough. So Jupyter comes with Anaconda Python, and it's an extremely convenient as an integrated development environment, or IDE, for fundamental and technical analysis. Now, editing code and running to visualize results is especially clear with Jupyter, and it's platform independent, so it can be run on Windows, on Mac, or on Linux. With that said, a quick commercial break, but like from a once broke professor who actually made it work. If you're working on your finances, I made a free guide that might help. It's called 10 Money Moves to Make Before Your Next Milestone, and it's the exact checklist I used early on to start building real wealth. You'll find the link below. Short, practical, and completely free. Now that I've sold you on something that costs exactly $0, let's get back to our regularly scheduled program. Now, it's important to clean and prepare your data for analysis with the goal of predicting out-of-sample returns. With data cleaning, for instance, we want to handle missing values through imputation, for instance. For example, with imputation, we might use something like mean substitution, so substituting the average of the data, or the nearest neighbor, like whatever the closest available data is in the sample. Or we could use some kind of polynomial interpolation. It could be line, like a straight line, join the dots, or a cubic interpolation. They're usually the more popular ones. Or an average, right, of the adjacent values. Or we can use removal rather than imputation. For instance, if you are missing more than about 50% or more than half of the values, probably should consider just dropping that particular variable, right? You just don't have enough data. There's too much missing data. So imputation is usually, it's a bigger problem the more missing values you have in your sample. We can also remove or adjust at least the outliers that could distort your results. So plotting your data and seeing, let's say there's a straight line through your data and all of a sudden there's like one weird spot, something like that. Again, you could remove trends or get growth rates rather than the actual levels of the variables. Now you're going to want to check for stationarity here. There are multiple statistical tests, but when you plot your data first, just see that, okay, if I look at my data over time, is the average. If I look at the first half of the sample, the second half of the sample, for instance, okay, the first half, the average is maybe here, this level, but then if I just looked at the second sample, the average is here. If I looked over the whole sample, the average is changing across time. It's an approximation, but also let's say the data is very calm and then all of a sudden it's very wild. That means that the variation changes over time. So your data is non-stationary. Usually you're going to need to adjust for this. Sometimes removing trends or detrending your data can work if it's like something like going up like over time, like a gross domestic product or GDP, like an economy, or inflation, or some stock returns. Sometimes the actual stock, the price level, you want to look at the returns, getting growth rates, etc. You could also normalize your variables. So usually that means subtracting the mean or the average from each data point and then dividing that difference by the standard deviation or the square root of the variance. Or you could standardize the data in other ways just to ensure comparability across variables. Now, we're really getting into feature engineering at this point. We create ratios, it could be like debt to equity, price to earnings, these kind of things, or indicators, or generating lagged. That's basically looking at the past period or previous periods, plural, or moving averages. So that's thinking about taking the average over a certain number of periods and you're kind of rolling that window. It could be the last 9 periods and you're getting the average of those 9, then the average of the next 9, then the average of the next 9 as you're moving it one at a time. So you're getting a kind of a window of moving averages like that. Now, that can be different numbers like 9 or 50 or 120, depending on what you're doing. When you're doing lags, so historical data, or when you're looking at these moving averages, you're really getting into the time series, right? You're bringing the time series alive. Another thing you could do is perform some kind of dimensionality reduction techniques. If you've got too much variables or a lot of variables, all of a sudden you've got the kitchen sink trying to explain everything. And it could be that you have, let's say, this is a silly example, but something like GDP and GNP, so 2 aggregate measures of the economy, they're going to look very, very similar, or they're going to be tracking each other, little differences, right? They're going to be correlated variables. It could be that you have market capitalization or the size, but you have some other variable of the size, maybe enterprise value, which is quite similar to market capitalization. And maybe having one or the other, right? You don't need to have all of them, but you may need to use some kind of dimensionality reduction techniques if you're dealing with many correlated variables. They're kind of moving together. There's what's called multi-collinearity problem, and there's different ways of testing for that. And we can also create labels. Like, for instance, if you're defining the target variable, that's what you're trying to predict, versus a predictor, right, or a feature, or an input column of variables, the things that you're using to predict that target variable. So it could be that you're trying to predict the price direction, or you could be predicting the returns, and you're using some other like fundamental variables, or you're using some technical variables as predictors. Now, EDA, or exploratory data analysis, it also includes visualizing relations between variables. I love visualizing relations. Now, this is good when you're doing something at the beginning, and if you've got time to do a lot of it, it's also useful. But when you're doing this at scale, you're automating it, etc. At some point, you're probably not going to be visualizing it all the time, right? You're going to be using a computer ultimately for doing algorithmic trading. But when you start, it's always good because, again, you can get a great sense of what's going on just by looking at the variables without even running tests. Because if you run more and more tests, the chance is that as you run more and more tests, you might start to not believe your test because there's an issue with multiple tests, the actual power of multiple tests, and the probabilities start to stack up. So it's usually good to at least explore these. But then, you have that issue also at the same time. There's a trade-off, right? Because then you're relying a lot on human eyes. And you're able to, you may be seeing patterns that probably don't exist. But it's good to visualize the relations between the variables. You might be able to use that to inform subsequent analysis. So exploratory data analysis, plotting the data, plotting bivariate scatter plots to see like 2 variables, how are they related to each other? Do I see some relation, positive, negative, etc.? Just basic analysis. And that can help you inform your subsequent analysis, for instance, in coming up with some statistics or some tests and hypotheses. Next, we have some simple models. Something like a logistic regression is usually quite common here in fundamental and technical analysis when we're looking at trading. If you're doing something like logistic for prediction, that's good as a starter. As you get further on, some kind of regularization, maybe some kind of elastic net with maybe some cross-validation. And here, scaling is usually important. You could try a min-max instead of standardizing your variables. There's all different ways. This is where, it's good to understand what's going on, but a lot of this stuff now these days, you can get a lot of help even from ChatGPT. You can then split your data into training and test samples. So maybe you have 80% of your data, the first 80% of the data you're using to train your model, and the last 20% you're using to test. So the model only sees the first 80%, you feed it in for that, and then you try to make predictions and compare your predictions with the last 20%, the most recent 20% of your data, and see how close your predictions lie with the actual data, the last 20%. And that way you can test it. Obviously, if you're just predicting with existing data, it's useless, right? Because in that case, you're really just already using the data. So it's going to hit it. It's going to match it. It's going to fit it. But you want to fit your model to see how good it fits the model to the training data, and then evaluate the model performance on the test data. Now, with more advanced models, we're getting into like machine learning properly at this point. There's the selection of the model. There's tuning some of the what's called hyperparameters inside the model, and by changing those, you can get very different results. You can train your model, you can evaluate your model, just like before with the logistic and other models as well. And we can combine also multiple models. This is actually quite popular. From my experience talking to people who are working in policy and some of the top economic institutes, for instance, the European Central Bank, a lot of the central banks in the European countries, as well as the Federal Reserve, a lot of people who were running their econometric or macro forecasting predictive models, they typically have the belief these days that there's not just one model that actually explains things. So they like to look at an averages, and usually in what's called a Bayesian setting, it's like we know that the economy is probably determined by some model, we just don't know what it is. So we put probability weights on various models. And maybe there's a chance that this model explains it, but there's another chance that this model explains it. So using multiple models is great because you're using more information. More information usually can only help you. So you can combine multiple models, for instance, by using ensemble methods to potentially improve the predictive performance. At the end of the day, we're just trying to hit a target, right? And hopefully some multiple targets, right? What are the targets? It could be that you're trying to target, for instance, the Sharpe ratio, something like the return to risk. The higher the return, the lower the risk. Things like that. Or it could be that you're trying to target the maximum drawdown. So maybe like the biggest drop in your portfolio is 50%, and you want to minimize that, right? You hopefully don't want to get a huge drawdown. You don't want to wipe out your bank balance, right? You don't want to wipe out your account. Now, ultimately, you really want to validate your model with these back tests. So using historical data, right? So if you have built a model, now let's see how it performs on maybe a different set of data. It could be a different stock or a different asset or a different time period that you hadn't looked at. It could be a different country even, for instance, right? You want to check that out and use out-of-sample testing as much as possible. So you're looking at training it on one particular period and you're testing it on another period. You're predicting ahead. You're really just using completely out-of-sample data set. You do not want to be testing on the same data set. That's just, no, that's a no-no. I give my students an F if they were doing something like that. The same for retail trading. You can also do walk-forward analysis, going forward into the future, and you could use paper trading accounts as well, probably playing with the sandbox. So rather than playing with real money, try to use the real world data, like right now, that's live, but it's not live in terms of a live account. You want to be using a paper trading account so that you don't make mistakes with using real money at first. Okay, this is not poker where, you can only really learn from emotions by playing with real money. No, yeah, you can learn a lot more when you're playing with real money, but I would say try to make as many mistakes first with fake money. Make many mistakes first with paper trading and using sandboxes before you go live. All right, here's where I download my brain into yours. If you're serious about building real wealth, I put everything together in one full course, from $0 to Multimillionaire. It's basically me handing you 20 years of hard-won financial knowledge, covering personal finance, investing, real estate, alternative assets, taxes, and financial freedom strategies. Links below, and you can use code Michael for a discount. Start wherever you're at. Just make sure that you're moving forward. That was the course plug. Now let's make you unstoppable with money. Now you should also analyze the importance of the predictors or the features, right? Which particular variables have the strongest influence in terms of predictability. So maybe there's some variables that you can just throw out and some variables that you can keep inside your model and you can keep and you can retain. What are the most important ones? Also use economic intuition, right? Does this make sense? If it doesn't make sense, it could be that you're overfitting your model and that it only works with historical data and the model is going to break down in the future. So the more you can think through this clearly in terms of intuiting, why is it the case that this particular variable would predict this direction, etc. You should think about this quite a lot before you deploy the model in real time. Now, once it goes live and you're using real cash, real money, it is highly important to monitor the model performance. So keep watching to see, oh, it's losing a lot of performance, it's no longer working. The model works until it doesn't, and you don't want to keep using it when it's not working. And you want to update it, right? If you can update it, again, there's some people update it almost too much and they're guilty of maybe overfitting. Or you may want to remove parts of the model or the model entirely. You might want to just take it off and it's better sitting in the sidelines in cash and just waiting a lot of the time than basically blowing up your count because your model no longer works. So you got to figure these out. It's a bit of an art, it's a bit of a science. So there you have it, folks. Using AI with coding to pull, prepare, and analyze data for prediction. Well, it's far more accessible than ever before. The power is literally under your fingertips. And speaking of fingertips, power through it by smashing that like button and clicking subscribe if you're not already a subscriber. Until the next time.